All right, welcome back to Two Stupid Guys Trade Stocks. I'm Vinny.
I'm Dylan.
Today, we're going to get into Intel's third quarter of 2021 earnings. It was it's interesting when you see a company like Intel lose like 12% of their market value in one day. So it was definitely an interesting earning report. So we're going to talk about that. I am an Intel shareholder in full clarification there, I guess. But yeah.
All right, and if you like this kind of entertaining stock market content, we're just two stupid guys trying to figure everything out. So give us a like and subscribe.
We'll get to it.
Two stupid guys trade stocks.
All right, it was a little brutal. What do you think of this little red bar? Look at the volume on that too, huh, Dylan?
Yeah, you're gonna like this one. I'm gonna crap on Intel a lot during this.
Okay.
I also did buy some because
why did you buy some? You've been an AMD bull.
This was such an unwarranted drop.
Okay. All right. So you
I bought it
like
for it. Yeah, I bought it $49.80 because I'm like, this isn't real.
Yeah, that's all right. I think you're at a good entry point there, but we'll see. So major Q3 highlights, basically 18.1 billion, which is representing about 5% year-over-year growth. Gross margin 57.8%, and earnings per share at $1.71, 61 cents above guidance, and 59% up year-over-year. What do you think about that? Like, do you know why that happened, or?
I mean, that part's great. It's the one thing that they said that everyone was very mad about.
Okay, so
this is great. They're a huge company. They're killing it.
Yeah, this is pretty good. The 59% year over year earnings per share growth is not a sustainable thing. That was because of a one-time special dividend from McAfee. So that's not something that would be repeatable. But overall, a company Intel size growing 5% year over year, especially when we had the pandemic last year and you had this massive kind of pull forward in terms of computing demand, and people were staying at home. Even still this time last year, people were pretty isolated.
Yeah, when I say great, I was expecting their numbers to be negative. I thought the chip shortage would have affected their numbers way more, and it didn't.
Yeah, I would agree. So this is kind of one of the first things you get into that's like a not so great. So this client computing group, which basically is processors for PCs and laptops, and it was down. The revenue from that was down 2% year over year. Intel basically cited a component shortage in other areas of the supply chain, so laptops weren't able to be manufactured, and that's why the demand was down for their computing units. It was mostly laptops that were down. Actual PCs were up. Well, I thought they were, but yeah, right here, desktop 20%. I'm like, wait a minute, where did I see it? Yeah. So, and the data center group was up actually 10% year over year. One of the things Dylan had talked about, we did an Intel versus AMD video, is how AMD was, starting to make bigger inroads into the server chip with their EPYC lineup. Which is certainly, been partly the case. I mean, you see the operating margin here is okay, 32%. It's lower than the rest of their business units, but they were able to grow revenue still at 10%, which is pretty good.
It is. It looks like they're finally done digesting. That was their excuse last time.
Yeah.
They're like, yeah, everyone's digesting, all the chips that are out, and then AMD's like, oh, we're up like 100%. It's fine.
Yeah, it's digesting. Yeah. Mm-hmm. Yeah. Excuse me. Sorry. This is another kind of area of growth that I thought was pretty respectable. Internet of Things, connected devices. I kind of have a smart home setup. I don't know how much you really got into that technology a little bit, but pretty solid growth. They're continuing to grow. You're looking at 54% revenue growth in that area. This is now over $1 billion in the quarter, which is interesting. Like, if you think about it, this little other business segment for Intel is still like going to be looking at over $4 or $5 billion a year, and AMD currently is about $14 billion in revenue. So this other business segment is like a third,
which is precisely why I bought, because it was at like 9.5% down. I'm like, this is crazy.
I know. I was thinking about doing like a sum of parts kind of analysis as far as Intel. Are you familiar with some of parts analysis at all, Dylan?
Is it just looking at each individual business like separately, each
Yeah,
component of the business separately?
exactly. Yeah, you're just assigning like growth multiples to each portion of the business because this $1 billion of revenue growing here 50%. Like if this were spun out in an individual company and Kathy Woods was a fan, this would be selling for what, like 8 times
Oh,
earnings.
yeah, yeah. It'd probably be the same share price, to be honest, with the same flow.
It'd be equal to Intel in market cap probably.
Probably, yeah.
um, Now, for the rest of the year, not so great going into like the fourth quarter of 2021. They're looking at $18 billion of revenue, which is down a little bit compared to last year. Looking for some gross margin contraction pretty significantly, 53.5%, down from the 57% that they are currently. So that's good discount from where they are currently and a big discount from last year. And the EPS itself to kind of follow that trajectory downward here, 39% year over year, which is not great.
Yeah, not good. Not good at
Yeah.
all.
So this is a large part of why, you saw this massive stock price decline is that, yes, Intel is, doing okay, but they're painting their picture for the next couple of years as not so rosy, and stocks are priced on future expectations.
Right.
So for the whole year, they're looking at basically flat from prior year. The gross margin of 57%, which is pretty solid, and about $5 in EPS. Granted, this includes kind of that special dividend from McAfee, so not entirely. It's not repeatable. It's not continual income that they can expect year after year and continue to grow upon. They are investing very heavily in CapEx here, $18 to $19 billion. Most of that going into your home state of Arizona, there, Dylan. All
I
those.
know. I drove by it actually.
Did you? Oh, cool.
Yeah,
And there,
huge.
I didn't put it in here, but they had a picture of it. It looked kind of cool.
I can go take one. It's about 30 minutes away.
Yeah, that's funny.
Yeah.
I didn't realize it was that close to you.
It's 30 minutes.
They gave some outlook for next year. This is kind of the number that caught me by surprise a little bit here. This 10 to 12% CAGR for the next 4 or 5 years. That's pretty impressive. I'm suspicious of that. Now they haven't achieved that recently. They're basically flat, maybe a couple of percent or so. Some of the models I saw they were 6% basically growth. But I wanted to look at it and see what would happen if they achieve this low 10%. The other thing that I thought was interesting from this, they talk about the gross margins to contract for the next couple of years as they invest in those new fab production centers. Now, the whole idea behind these fab production centers is that they're going to become a foundry business, right? So they're going to manufacture chips for other companies.
Right.
Do you think the profit margins are bigger when you manufacture something for someone else, or when you design and bring your own product to market? What do you think the bigger profit margins typically are?
I would have thought it was design and bring profit to market.
You're correct. So to me, they are kind of, I don't want to say shooting themselves in the foot. That's a little aggressive, but they are definitely trading a more profitable product line for a little less profitable product line.
Just to be clear, I said this before with AMD.
Yeah.
There's this crazy company who also did this and designed stuff and then built a fab, and then they did too much and went bankrupt, and their name is AMD.
Yeah. Now
they didn't go bankrupt. Did they? No, they didn't.
Nah, they've come up in the news recently too. I forget, there was a recent article about them, but I think at this point Intel is reading the flow of the sand correctly, because companies are going to continue to move towards in-house design of their own silicon. Apple has shown that it's a sustainable business model, that they're able to achieve things that they wouldn't have been able to achieve through the continued Intel partnership. You're seeing other big tech firms like Amazon moving in the same direction. I don't think that's going to stop. I think you're going to continue to see this. Even this is one of the, I guess, positives that came out of this whole thing, is that Intel was able to secure one of their first contracts for their foundry business, one with Amazon and the other one with the U.S. government. Do you know that?
Yeah, I know. Yeah. I saw the U.S. government one.
Yeah, and Amazon as well. But it's definitely interesting. I don't think you're going to put that genie back in the bottle. Companies or large tech companies are going to continue to design their own silicon. So I think it was something that was going to happen regardless. And Intel is investing, I think, appropriately in terms of the right time to get in that. But ultimately, if you look at Taiwan Semiconductor, Taiwan Semiconductor's gross margin is down in this area about 49 to 51%. And I think that's where Intel is going to probably end up trending longer term. So I don't believe that they're going to move upward after this time period.
Yeah, I agree. I don't think so either.
Yeah. Continuous CapEx for a few years, completely appropriate. Like I said, I think it's wise and it's needed at this point in time. Dividend, I don't like to get pinned down to a dividend because I enjoy dividends, but I think companies can sometimes get so focused on having a good dividend and growing a good dividend that they can hurt the business, and it's whatever. So I haven't seen them do anything like that yet. So what I did is I used this current projection for 2022, and I grew it out at that 10% CAGR until 2026. So now you're looking at Intel having about $108 billion in revenue. Possible. All right. They're at like $80 billion a year right now. So that'd be $30 billion over the next 4 years. I think it's possible, right? I kept their gross margin at 51%, the lower end of their guided range. They're talking about a gross profit of about $55 billion. All right. I looked at Intel's recent 9-month kind of performance in terms of net margin compared to gross margin. And I'm looking at about a $24.75 billion in net profit in 2026. I used the classic PE of 15. Now, Intel has traded under this for a while.
I think they're at 11.
Yeah, they're, exactly. They're in this low teens territory. It's unreasonable to expect a company to stay in that ballpark. Even 15 is honestly kind of, people will talk about that's the 120-year average, basically, of the S&P 500. In reality, of the last 30 years, 40 years, you're looking at it closer to 20 PE. So I think
Apple's 29, AMD's 42.
Yeah. So using 15, I think, is reasonable.
Yeah. NVIDIA's 81.
Overly aggressive there. Yeah.
No, you're not. If you think you're being under, I would have done 20.
Okay. I was like, Tesla's what, 124? Separate video.
I have it up. NVIDIA's 81. Oh, Tesla's not 100. It's just 476.
Yeah. That's the trailing. We need to look at the forward PE. Okay.
Forward PE is 124.
Yeah, there you go. So we're looking at having Intel with a market cap of $371 billion, right? They're only $200 billion market cap right now. The other thing that Intel has going for is that they aggressively repurchase shares. So $371 billion market cap. They've been slowing down a little bit. Their 5-year average is around 3% share repurchase per year. I modeled out the shares 4 years in the future using 1% per year, which is what they've done with the last 12 months, meaning they'll have about 3.9 billion shares outstanding. So it gives me a 2026 price projection for shares of Intel at about $94.59. All right. This is excluding dividends, not looking at dividend reinvestment, any of that sort of stuff. Just the shares to be trading around mid-90s, I think, is reasonable in about 4-year time, if they hit that 10% CAGR in terms of the revenue after 2022. So if you're actually looking at in terms of investment rate of return, if they were to hit that $95-ish a share compared to the current share price of about $50 a share, you're looking at about a 17% CAGR on your investment from this point forward. Just very good, I would say. I personally aim for at least 15% is kind of what I do. If I'm not earning 15%, it's probably not worth picking my individual stocks. But so that's kind of the metric I look for as a good investment.
Right. That makes sense.
Yeah.
I will say after the bubble, the Intel bubble, I guess the .com bubble, all of these companies went. So I will say Intel is a hated corporation. I don't like them at all. I'm going to be fully open to that. I own some shares now, but I don't like them at all. And the reason is everyone always says, don't look at what you can make in a year. Look at what you can make in 20. Right? So let's just do 20 years later from when all these tech companies tanked. You have Apple, which is ridiculous, but AMD would be their competitor, if you will. With all these share repurchases, everything, all the share purchases they've done, which you've done a whole video on, they're still not at the price that they were at the .com bubble.
Yeah.
They're still not there.
I know.
And it's been 20 years.
Mm-hmm. Yeah. I want to say they've more than tripled their revenue. They've quadrupled their profits. They've decreased their shares outstanding by more than 20%. I want to say, it's funny. If you watch the Everything Money guys, I want to say Paul has gone off on the same kind of rant before about how they're literally hit these expectations of a classic hype stock would be hoped to, and their share price is still down.
That's why I won't invest in them long term. I'm doing this as a little swing. I'm doing this as a very small little bit. I will not invest in long term because Wall Street doesn't like them, and we dictate the price by everyone trying to buy them, and no one likes them. So therefore, I don't know why. It seems like it should be a solid investment, but over the last 20 years, it should have been a solid investment. And if you put all your money in Intel versus just like anything else, you did not do well.
No. Now, the additional thing that I kind of do with this, since like it's kind of a dog stock, and since I was kind of expecting it to be a negative reaction on earnings, is that I sold a covered call against my position. So I sold the I think it was November 19th, 57.50 covered call against my shares. I like to try to trade in 100 share blocks. That's exactly what I own of Intel. So I'm earning dividends. I'm earning premium from selling covered calls against my dividends. And I actually entered my Intel position by selling cash secured puts to purchase it. So I'm earning options like income basically on both sides of the transaction. Is not officially, I don't consider myself doing the wheel on Intel, but that's effectively what I'm doing.
Right. No, makes sense. Yeah. I was gonna wait for AMD's earnings to come out to buy more because I think they might go to 48. And I'm trying to get 100 shares, and I'm just do covered calls, say like 50.
Yeah. No. Nothing wrong with that. All right, guys. Well, let us know what you think about the Intel's Q3 2021 earnings. We'd love to hear your thoughts.
All right. Thanks, guys.